Welcome to the Trust Us, We're Professionals podcast with your friends from SSC, CPAs, and advisors. This is a podcast where we break down financial matters found in pop culture. Basically, we make complex financial matters more consumable for our listeners. I'm your host, Chris Underwood, a financial advisor with SSC Wealth, and I'm once again joined by the lovely Michelle Hammond and Chris Cohart. Michelle, Chris, how we doing?
I'm excited about this one.
I'm so excited.
I mean, I've been excited about all of them.
That's what I was about to say. This is the first time you're happy about this?
But we were really excited about, what we're connecting to this.
The light bulb that went off when we talked about this in the conference room could have powered the whole city. I mean, it was one of those aha moments.
It was. I think this episode is Cohart's glorious purpose.
I was excited about the glorious purpose component of it, but I really didn't want to talk that much about how we're the content topic.
Okay.
Remember, I was pulling down the electricity, but like, oh, you're right, but I don't really want to talk about that, even though it's really important.
Really hates being an expert.
Okay, well, let's get to what we're talking about today. In today's episode, we're going to talk about an overlooked complexity for small business owners to deal with, and that is understanding economic nexus, or more simply, as a business owner or seller, what state do I pay sales tax or use tax to? And we're going to explain this by referencing our favorite Disney Plus show, Loki, hence the glorious purpose reference. And this is your spoiler warning. If you don't want to know anything about Loki, turn back now! Too loud, PJ? Too loud. Okay. Turn back now. So...
I heard ringing.
Yeah.
You heard ringing?
Do we owe him for the equipment?
Yeah, did I just break the mic?
You're not going to break that
This is why we need to mic up PJ. I've been saying this for a while now. Okay. Full circle. How in the heck does Loki help explain economic nexus?
Well, that's an interesting point. I think to use Loki to explain it, how about we have Miss Minutes talk about it?
But then the all-knowing timekeepers emerged, bringing peace by reorganizing the multiverse into a single timeline, the sacred timeline. Now, the timekeepers protect and preserve the proper flow of time for everyone and everything. But sometimes people like you veer off the path the timekeepers created. We call those variants. Maybe you started an uprising, or were just late for work. Whatever it was, stepping off your path created a Nexus event, which left unchecked could branch off into madness.
How we doing?
I just love her.
Yeah, I like Miss Minutes too. Okay, Chris, Michelle, I'm not sure that helped explain which states business owners pay sales taxes to. So can we please explain further?
I really thought that would cover it.
Yeah, I thought we were
That was
good.
it.
That was it.
Thank you for
Podcast
joining
over.
us today. No.
All right. So in our accounting brain, as we're watching this, weird things pop in to our head of how something like that ties to an accounting issue.
We've already established, Cohart, that people don't want to watch movies with us.
That's true. Okay.
So Loki being the same as it was, right?
Yeah.
We're watching Loki and a bell goes off and says...
Correct. So in my mind, the timekeepers up until, what was it, 1992, Supreme Court ruled, and that Supreme Court now became the timekeepers in my mind. All these rules of how we were doing economic nexus all got consolidated into one rule, is now our, I can't think of the name of what's the timeline?
The sacred
time.
timeline.
So 1992, they ruled and created this sacred timeline. They ruled in the Quill versus North Dakota case and became kind of the standard of what economic nexus is for businesses. So now we have the sacred timeline, and the Supreme Court in 1992 is our timekeepers. And then we have the precedent for this. And really what Quill versus North Dakota established was that a business had to have some form of in-state physical presence before a business could be subject to sales and use tax requirements.
Okay, let's break that down real quick. Okay, so if I have a business in Kansas, and I'm shipping to Texas, but I don't have a location in Texas,
Right.
I don't have to collect and remit sales tax.
Correct.
Okay, so this was the glorious era of if I bought stuff online as a consumer, and they didn't have a location in my state, that I was only responsible for reporting that on my use tax form. They weren't charging me sales tax.
Correct. And,
Okay.
and Amazon was argued that Amazon was getting a competitive, that's how they grow their competitive advantage because they were shipping to so many different states, but they weren't having to charge anybody sales tax for it. And yes, they, in theory, should have been paying use tax on their personal income tax return, but I don't think that happens as often as we would hope would happen.
I guarantee that it doesn't happen as often as the states would like it to.
Right. So all these states.
Okay.
So I'm a business owner. I'm a purchaser. I'm not charging sales tax. I'm having to fill out my sales tax form that says I made these sales, but then I just say, hey, I shipped these to another state, and so it's not part of what I have to remit or collect sales tax on.
Okay.
So we had this sacred timeline until 2018, and in 2018 we had Sylvie come around, and she decided that she wanted to tear the entire system down. And Sylvie,
She wasn't buying into this sacred timeline, was
no.
she?
She's North Dakota in this situation, or South Dakota actually in this situation. She's South Dakota in this situation. Let me fix that. Here comes Sylvie along in 2018 and wants to tear the entire system down. And Sylvie, in our case, as we're watching this, is South Dakota, the right below North Dakota, who had established a sacred timeline but turned her back on the other Dakota and said, "No, I'm not doing this. I don't like this system." And they went to the Supreme Court, this Wayfair versus South Dakota, and decided that she needed to kill the sacred timeline, which is our Quill versus North Dakota. In 2018, she did it. She kills the sacred timeline, blows everything up, kills he who remains, who I'm going to call the idea of the 1992 Supreme Court. That is who she got to and said, yeah, I'm not agreeing with you, and so I'm going to blow this up. And we have Wayfair versus South Dakota, which gave all the states much more leeway into determining what is creating economic nexus. We didn't just have this kind of standard rule. Now every state potentially has their own rule. So when I'm watching Loki and that scene with Miss Minutes where all the branch timelines are blown up, that's all the given states creating their own rules and standards as to what creates economic nexus in any given state, whether it's sales tax, use tax, property tax, payroll tax, income tax. There's all kinds of timelines. It's just utter chaos.
Wow, or even more appropriately, holy shit. So basically, in 1992, Quill versus North Dakota established that unless you had a physical building, if you will, you don't have to pay sales tax to other states.
And physical presence could be employees or salespeople in those given states.
So some sort of physical presence. So lots of people weren't paying sales tax to states they were doing business in just because it was online or whatever it may be.
Right.
And then Sylvie or South Dakota versus Wayfair in 2018 Supreme Court case, they said, no, each state can decide, how much they want to charge you if you're selling in their state, even if it's online.
Right. And we'll have to acknowledge that economics changed a lot just on how we were purchasing and buying things from 1992 to 2018. So some change would need to occur because a lot more people were shopping online. We weren't going to the stores as often. And that's, like I said, Amazon being kind of the biggest individual that benefited from this and their growth because they were shipping all over the country. Now, I think they did have distribution centers in a lot of places, which would create physical presence, but they still weren't distribution centers in all 50 states.
Okay, so what is this? I mean, this makes things a lot more complicated. Just like in Loki, spoiler, they, kill he who shall remain nameless. What's his name?
He who remains.
He who remains.
He who shall remain
Well, they
nameless.
actually never name him in the finale, so it kind of
true.
works. Yeah. But anyway, so now we have all these little, different timelines, sprouting off, and now each state can kind of make their own rules. as far as how they want to handle sales tax. What does that mean for a business now?
It's a good question.
Thank you.
That's a very
Thank
good
you.
question.
Whew, one every 13 podcasts.
Keep swinging.
So what that created is, in a sense, 50 different rules that a business owner is going to have to at least acknowledge or gain some understanding of.
Right.
And it's just not as easy as some one person asked me to ship this piece of paper or this widget to Wyoming, and no big deal. The widget was only $2. You're going to have to know what the sales threshold might be in Wyoming to see whether you're going to have to charge sales tax in that state or collect sales tax in that state or not. So Wayfair essentially created a sales and or a number of transactions, or a dollar and a number of transaction thresholds for any given state. Now, not every state has done that. Most states have, but not every state has done that. So you may have one state that has an income threshold or a dollar sales threshold of $100,000, and then state B may have a dollar threshold of $250,000 or 200 transactions. So in each one of those situations, you're going to have to know, if I'm shipping to this location, does that trigger the sales tax or not? And it could just be if you did one transaction for $100,000, because that's the product that you make, that in itself could trigger a sales tax collection for that given state, even though it was one transaction. Or you can sell $250 widgets, and that's going to end up being enough, even though it's only $250 of sales in that state. You've now gotten over the number of transactions threshold to collect sales tax in that given state.
So you're kind of going along in your business, and we have our sacred sales tax timeline.
Right.
And you're carefully tracking things, right, as the TVA was monitoring the timeline. But as you're creeping up or creeping down away from that timeline, so as you're selling more or as you're entering new states, you are slowly and carefully edging towards a Nexus event.
That's right.
Do you get it, guys? I know it was a big buildup, okay?
Right.
But as you hit close to state A's 200 transactions, you're kind of watching the branch go off, 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 up. And all of a sudden, kids, you have Nexus. And Nexus means you need to register, right? Collect and remit. And at some point, if you're shipping all over the United States, you are filing sales tax returns in 50 states. And you possibly are also creating income tax nexus, where you also get to file income tax returns in all 50 states.
Right. And to tie it in, I was thinking that the TVA agents, once you got to that Nexus event, was the state revenue tax agents.
And they have those sticks that send you into nowhere.
Right.
The void, is that
Absolutely.
where it sent them, the void?
Right.
Absolutely. I've seen them. They've got them.
And I think every state that incline of the Nexus event was slower or not. And you remember there's a scene in there where Sylvie and Loki are sitting on the planet that's about to be destroyed, and all of a sudden they had that huge spike that had grown as fast as any Nexus event has ever done.
Is that when they kissed?
I don't think they kissed there.
Not that one. When
Not
was the
that
one where it
point.
went so high?
That was when they were about to die on the planet.
Oh, yeah.
And the planet was dying, and they had realized that they loved themselves, I think is what the point of that might have been.
If you guys had the opportunity, would you make out with yourself?
No, I don't like myself that much.
I think I'd want to know.
Oh, my God.
But what I thought when I
What the
was
hell's wrong with him?
when I was so every state has these kind of different spikes, like Michelle was saying, that they increase a little bit faster.
So if you hit the threshold, if you hit the nexus, the economic nexus, and you have to start reporting, I mean, I'm sure people try to skeet this and get around it. Can you give me some scenarios or examples that would get the TVA or the IRS or whoever it may be knocking on the door?
So if you don't do it right, what happens? Is that what? Is
Yeah,
that where
yeah.
you're headed with
Yeah,
this?
yes.
Yeah. I mean, essentially, how you're typically identified through these processes is one of your customers is audited by the state in which they do business, and they go through the purchases of that customer of yours that's being audited, and they see that you didn't charge sales tax and that customer didn't pay use tax. And if that happens enough, then they go on through to you and say, I see you're not charging sales tax to this customer in Kansas. Tell me why, or how about we do a little audit on you too?
Yeah, and the risk for the businesses is that you have an obligation to collect sales tax on those transactions. So if you don't, it has to come out of your pocket.
Right.
You're responsible for the collection and remittance of that sales tax. So if you didn't, sorry, that's on you. Now, I have seen where the states, like Michelle was saying, they come in and audit somebody. They'll collect it from the person that should have paid it, and then they'll go collect it from the company that's supposed to charge it.
Ooh.
Yeah.
Bonus.
Yeah, absolutely.
Double dipping is what it seems like.
A little punitive. Because, sales tax at its core is not a cost to the business.
Right.
Complying with sales tax rules is an absolute cost to the business, and being able to monitor all your sales in all of the states, do the reporting and all of those things. But at the end of the day, it's a trust arrangement where the states are trusting you to charge, withhold, and remit those amounts.
Correct. And this is just from a transactional perspective. This is selling widgets. This is whatever the case might be. Selling widgets, and we're now. I always use widgets. Widgets are what we used in school.
I know.
They always use widgets as an example.
And I don't know if I've actually seen a widget, but when you say widget, I think of a sprocket or a clock or something like that. Maybe we should just say.
I think of a fidget spinner.
Yeah. There was
fidget. I don't know.
We're older. The fidget spinners were not a thing when we were in college.
When you say sprockets, I think of the Center of Life sketch.
Yeah.
Yeah.
This is the time on sprockets when we dance.
Do I set him up to be able to do those things?
Maybe.
I. Is it just that so much of what I say can get tied back to an SNL skit? Probably.
SNL's been around long enough to where I think there is a skit for everything.
Okay, so that's if I'm like doing tangible goods.
Yeah, that's
I'm selling trucks.
That's
right?
those are the appropriate words. Tangible personal property. Yeah. If I'm selling tangible personal property, those are the rules.
Yes.
Now, if you're providing a service, Wayfair versus South Dakota did establish some rules as it relates to sourcing the revenue from services as well. Mm-hmm. And there's really three basic forms of sourcing revenue for services. It's cost of performance, which in the end, cost of performance, you end up just basically filing one sales tax return because it's really where the majority of the services are provided. That's where you're going to end up filing the revenue for that state. Okay. Now, whether the service you're providing is taxable in any given state is up to those states, always has been. Some, like accounting profession services, are not subject to sales tax, but some construction services are. The other being modified cost of performance, and that you're going to end up filing multiple states because you just allocate the revenue in each state in which you perform based off the percentage of that revenue state as a percentage of the total revenue for the state, which I think is probably the most. I don't know, we see that the most for people that do service based in a lot of different states.
Yeah.
And the last being market-based sourcing.
I don't know this one.
Market-based sourcing is really that you're focusing on which state receives the most benefit. So if I'm in Kansas, but my client that I do 90% of my service with is in Minnesota, then all that revenue is going to end up in Minnesota.
Okay.
And that's where it's going to be subject to, even though maybe I'm still doing a large portion of the work in Kansas. State of Minnesota is receiving the benefit for those services I'm providing.
That gets more and more complex now that Zoom's the thing, right?
Absolutely.
Wow. Well, I was about to say, this just proves that you need a team of, trusted professionals to help you navigate this.
We have access to a huge database of being able to look these things up because it's not easy. It's not easy.
Sorry to cut you off, Michelle.
I never stopped you.
Yeah, that's right. I don't really mean sorry. I'm just saying it. Now, does this complicated sales tax immensely? Now, what about income tax? Same rules?
No.
No.
Oh, gosh.
It'd be great.
BJ, is your head spinning yet?
He's still awake.
I viewed this, I don't know if Michelle did, the income tax revenue agents as just a different branch of the TVA. So we said there was one sacred timeline, but there was actually two. There was the sales tax sacred timeline, and then there was the income tax sacred timeline.
And I think that's where we're headed in season 2 for Loki. There's a lot of timelines.
Right.
Will there be a podcast season 2, though, is the question.
We realized there was...
Not after this one.
Yeah. That sacred timeline
Yeah.
was established with the Interstate Income Tax Act of 1959. So that one
stuck.
That one stuck. And there's a lot more case precedent for that, so it's a little bit harder to tweak that one. Sylvie was going to have a harder time finding He Who Remains for that sacred timeline.
The end of the void of the void of the void.
Right. So that timeline is a little bit more set in stone. And for the most part, that is based off of a factor presence standard for Nexus. So they're looking at property, payroll, sales, and a lot of times it's one or all of them. It kind of depends on the state. But just like what Wayfair versus South Dakota did, there was some sales factor thresholds that you might have, or dollar thresholds that you might have, $100,000, $200,000, $500,000, $1 million before you really needed to file an income tax return in those given states. But again, those states all had different rules. That sacred timeline had kind of already had these little branch realities as to which each one of those states have, but they were more standard than they were with sales tax, where it was a little bit more loose
And conflicting. The different states, each state thinks that you should be paying taxes, income taxes in their state, right? I mean,
yeah,
they would prefer it over another state. And so their conflicting rules sometimes can lead to a lot of confusion for small businesses as it relates to, do I file an income tax return in this state?
Mm-hmm. And the Interstate Income Tax Act, it prohibited a state from imposing an income tax on a seller's business if the only thing that they were doing was solicitation of orders. And there's no physical presence. If all you were doing is advertising in a way in that given state, that state couldn't necessarily impose a sales tax or an income tax on your business to file an income tax return.
Because I put up a billboard.
Right.
But I didn't sell anything.
Right.
I don't have any employees there. They can't force me to file.
Mm-hmm.
Okay.
So the Interstate Income Act of 1959 stabilized things. Did anything kind of tweak with that sacred timeline at all?
No. That one, like I said, there's a lot more case precedent from a business perspective that definitely didn't really tweak much. Now, we focused a lot on the business side of things, but Michelle had mentioned the use tax several times, and that's on the individual side. So we do have some rules from the individual side for use tax, which is kind of the opposite of the sales tax. If I'm not charging sales tax and I'm using it, I need to pay the use tax at the sales tax rates. In the business, we have whether we file a tax return in those given states, and the business pays income tax where it passes through to those individuals. But those employees potentially also have to determine whether they have to file taxes in any given state or not.
Which I think is a really relevant thing to maybe talk a little bit about now, just given the way that people are working remotely and moving to different states, doing different things. You know, we're here in Lawrence, and we have an office in Kansas City as well. So we're intimately familiar with the concept of living in Kansas and working in Missouri and how that's taxed and what that looks like. But I think that a lot of other people really aren't. You know, the states want you to pay the tax in the place where you are earning your income. And when I'm explaining this to people, I kind of always lean back to the jock tax, or the Michael Jordan rule. And that was where, you know, at some point, the Bulls and every professional athlete was paying taxes in the state of where their home team was, right? And then they said, well, you might be paying taxes in Illinois, but you guys just played the championship game out here in California. So, and that was, you only play 25 games a year. You owe me 1/25 of your salary, right?
Mm-hmm.
And so they put in these rules in place as it relates to the performance aspect of your work, where you actually doing your performance. And so that's how many professional athletes and entertainers end up having to file in
20 plus.
20 plus states.
Yeah.
And the same applies to us, even though we're not rich. Is that there's performance based. So if I live in Kansas and I work in Missouri, Kansas, I'm a resident. I need to file a tax return over there, but I'm getting a W-2 that says and is withholding Missouri income because I'm working on the Missouri side. Before I say it wrong, Chris, do you want to tell people how that works?
Yeah, you always have to file a tax return in the state in which you're a resident on.
Period.
And subject the entirety of your income to that state's income tax. Mm-hmm. But you also file a tax return in the state in which you earn it, but only on the income in which you earn in that given state. So you do the state's return that you're not a resident in, you calculate the tax, and then you get a credit for the taxes you paid in that non-resident state on your resident state tax return. And usually what's left is the differential between your resident state's tax rate and your non-resident state's tax rate. So if Kansas is 5.9 and Missouri may be 5, you're probably going to owe a little bit more Kansas tax, but just that 0.9% of your income that you earned.
You're not
for the
paying
year.
10.9.
Right.
Right.
Right. You're going to end up paying the highest of the two rates,
Right.
essentially.
Yes.
But you
But
won't
it's not
pay
double
10.
taxation.
Right. We're not. A lot of times that's when we get an individual's return that they prepare themselves with multi-state. Yeah, they usually pay 10.9% because the software doesn't know to credit it back on the resident state return. But no, you're paying tax
When
rate
done
on
appropriately.
one. Yeah, when you're
By
done
by
appropriately, you file the non-resident state return, pay whatever rate that is, and you get a credit for taxes paid in another state on your resident state tax return.
Okay, so now I worked for Google. I realized that Palo Alto was way too much money to live in, right? So I hightailed it to Texas. What are those people facing right now with their W-2s and paying taxes?
Well, they would be filing no state income tax return.
Oh, I picked Texas.
You picked
didn't I?
Texas, right?
Well, that's the best scenario then. They left California, which is like,
Super high tax rates.
how much were you paying out there, Hollywood?
God, a lot. I'd have to go back through and look, but it was insane. And they tax you on everything.
Yeah.
Everything.
Their income tax rate is at like 14% now, 12.
I don't
I could
even
Google
know.
it. PJ probably could Google it, but I don't even want to think about it.
Right.
But so they left, and they weren't performing there in California anymore. They were doing their service and their work in Texas.
Mm-hmm.
So they kind of did they get a rave?
Yeah, Google just recently came out and said that
13.3.
wow.
For Google, 13.3. Just let
For
the record
California
show.
state taxes, 13.3.
Mhm.
Yeah, Google just came out recently and said, or there was an internal email that was released recently that said if you don't come back to your office, we've done some internal calculations and you could face up to a 15% pay reduction because you're not working in these higher cost states or cities. So if you initially were in New York and you've moved to Texas and doing remotely, there's a good chance that they're going to be cutting your compensation because part of your compensation is based off of the cost associated with you living in the location in which you're working at.
They should just make it a 13.3 reduction, just to make it real on the nose.
You can call him.
Well, yeah.
I'm sure you'd be just really popular with all of it. with
1-800-GOOGLE. Yes, I have something to say.
It's an interesting concept that
Yeah.
they have to, because you're working for a company in New York which has certain market rates for employing individuals, but you're not necessarily working in that jurisdiction. You're working in a jurisdiction that may have a different market rate for your position, and that's kind of what these companies are now facing with remote workers is that we're paying New York rates for people that are working in Lawrence, Kansas, and that doesn't make business sense for them. If they had a location in Lawrence, they'd be paying these Lawrence rates. Before we move on, I wanted to touch on that jock tax again, because the theory of how that came about is that it was the Bulls versus Lakers, and the state of California was retaliating against the Bulls for winning the finals, and that's why they started subjecting those athletes to income tax, because they were mad that the Bulls had beat them in the finals. And then Illinois is like, well, if you're going to tax us, we're going to tax you. So they started taxing the Lakers players, coaches, trainers for being in the state of Illinois during the finals. And now all the
so pettiness over
pettiness.
A game.
Right. That's just the word on the street.
Word on the street.
The buzz.
The buzz is that we're now, you know what? It was the Accountants Employment Act is what that was. Like, thank you. Like, right. So I don't like it. That's nuts. But whatever.
And they're held to a different standard, to be clear. They're held to a different standard than Michelle or I or Chris as well.
Right.
There are some different rules as it relates to when we are working in a given state, when our income tax, our wage is going to be subject to tax in that state. Like Michelle said, if I'm living in Lawrence, Kansas and driving to Missouri every day, it's going to be subject to Missouri income tax. But if I have to go visit our Kansas City office, which is still in Kansas, but our Kansas City office in Missouri,
not
3 times a year. 365ths of my salary isn't going to be allocated to Missouri.
Right.
If it's expected that my presence in Missouri is going to last 12 months, then that does become my new tax home. And then my wage does get subject to Missouri income tax, even though it's just a temporary situation for me. You see that a lot of times in the construction industry where they're having different jobs in different states. The expectations, they're on that job for 12 months, 18 months. That becomes their tax home. Then they have to start being subject to income tax in that given state.
That's right. I don't want to send up a flag where everybody starts calling their HR offices and saying, right, I'm spending time in Illinois, please start withholding, right? Like, right. That's not it. It's more of a, like you said,
right.
I don't say permanent, but semi-permanent, long-term
a nexus
situation.
A nexus event.
A nexus event.
Yes.
The branch is going up.
Right.
Up,
oh, you're going to be in Illinois on that construction project for a year? Nexus event. Now TVA agents coming down, banging on your door, HR saying, wait, you're going to have some withholding now.
Yeah.
So many Nexus events, so few TVA agents to trim the new timelines. So what advice, because there's a lot of information here, good information, but what advice can we impart to our small business owners?
These are complicated issues, and it's hard to understand all 50 states when you're just necessarily doing business the majority of the time in your given state. Because we touched on sales tax and we touched on income tax. But early on, we said there's property tax rules, there's payroll rules. There's still a lot more just tax rules as it relates to every aspect of your business that may come up. So having that good team of advisors that can help you navigate all of these rules, or at least acknowledging, hey, before you go in this state, you're going to end up you're going to have Mobius say, hold on a second, before you sell that product, you're going to create a Nexus event by doing this. Let's make sure that that's the timeline that you want to start operating on. You're venturing off the sacred timeline. Do you want to now be a Missouri business?
Yeah. So while the borders are coming down as it relates to being able to provide goods and services all over, the United States, North America, the world, right? Everything is a lot more international at its core. Know that before you do something or before you start selling or entering into other markets, to check with your professionals to get a total understanding of what happens at that point to make sure that that is the place that you want to go.
And before you you've communicated with your employees that, hey, a remote work environment is what will work for you and for me, understanding what that is for you administratively, because it does now create more filing for you as a business to allow or to have one employee in multiple states. But like
Absolutely.
Michelle said, as the borders come down, it makes it easier for businesses to have not just focus on your local jurisdictions for recruiting staff and employees, but recruiting nationwide. But that does increase the administration costs of your business because of all the things that you're going to have to do to employ someone in a state that you're not operating in.
Absolutely.
And there's a lot of compliance too that you touched on. So having trusted professionals around to help you navigate it is key.
Would you guys call? I think I might be alligator Loki. Classic Loki? Michelle be classic Loki because she's a
No.
more.
I don't know which one in the office tries to bite everyone's head off all the time.
Which one
Is
was
that the
voiced by Chris Helmsworth? The frog Loki?
I didn't know there was a frog
yeah,
Loki.
he's in
Yeah.
just very briefly.
Yeah.
He's in a
Oh.
jar.
Uh-huh.
Yeah.
You wanted to be frog
Hemsworth?
Loki?
No, I don't identify
You
with
did-
Loki at any
Oh.
like, personally.
Sylvie?
Well, maybe. I don't know. I just want to date Tom Hiddleston. I mean, there's a lot of steps that between here and there, but that's so probably not going to happen.
Well, I'd be remiss. We touched on it for a second, but what do we think of season 1 in general?
Of Loki?
Yeah.
I loved it.
I absolutely loved it. And I texted Chris at the end and I said, I think we could absolutely do a podcast based upon the very poor succession planning of He Who Remains. That's where I'm at. That's what
Right.
I wanted to do with this one. Chris is like, Nexus. I'm like, fine. Probably more useful. But I mean, if you get down to retirement and your two choices are take my job or kill me, and this is terrible. This is my favorite. That was my main takeaway, is that He Who Remains needed some succession planning.
Yeah, I would agree with that. But it feels like a lot of times the businesses we're talking with, it's pretty much that.
Kill me's never an option.
Kill me is not. It feels like that. If I have
I
to
know,
run
are
this
kids
business for
involved? Are
one
kids
more
involved?
day, I'm stepping up.
Just kill me. Take this job and shove it. So
Right.
yeah. I really enjoyed Loki. It's next to WandaVision, I don't know. You have to
The
put them
only
next
the
to
only
each
thing
other.
I loved the entire season, but I told Chris this. I didn't understand what their intention was when they got to the planet and they were running to the spaceship that they knew was going to explode. And why all the people there were fighting just Sylvie and Loki? Like, they had no idea who they were. They were all just people trying to get on a spaceship, but somehow they were fighting Loki and Sylvie. And even when there were like 20 seconds left, how do you intend to get on that spaceship at this point in time?
I think the whole purpose of all that was to set up the two Lokis potentially making out with each other. Okay, that's it for today's episode of the Trust Us, We're Professionals podcast, brought to you by all of us at SSC, CPAs, and advisors. If you ever have any financial questions, you can always reach out through our website, www.ssccpas.com, or email us, please do, with thoughts about who would be the SSC alligator Loki. The email address is podcast@ssccpas.com. Chris, Michelle, PJ, audience, all the Lokis out there, thank you very much. See you next time. This podcast was recorded and is being made available by SSC Solutions, Inc., together with its affiliates and its employees, SSC, solely for informational purposes. SSC is not providing or undertaking to provide any financial, economic, legal, accounting, tax, or any other advice in or by virtue of this podcast. The information, statements, comments, views, and opinions provided in this podcast are general in nature, and such information, statements, comments, views, and opinions in the receipt of this podcast by any listener are not intended to be and should not be construed as the provision of investment advice by SSC to that listener or generally, and do not result in any listener being considered a client or customer of SSC. The information, statements, comments, views, and opinions expressed in this podcast do not constitute and should not be construed as an offer to buy or sell any securities or to make any investment course of action. The information, statements, comments, views, and opinions expressed or provided in this podcast, including by speakers who are not officers, employees, or agents of SSC, are not necessarily those of SSC and may not be current. SSC does not make any representation or warranty as to the accuracy or completeness of any of the information, statements, comments, views, or opinions contained in this podcast, and any liability thereof, including in respect of direct, indirect, or consequential loss or damage of any kind whatsoever, is expressly disclaimed. SSC does not undertake any obligation whatsoever to provide any form of update, amendment, change, or correction to any of this information, statements, comments, views, or opinions set forth in this podcast. No part of this podcast may, without SSC Solutions Inc.'s prior written consent, be reproduced, redistributed, published, copied, or duplicated in any form by any means.